Good afternoon. Welcome to our monthly webinar series. We'll give it about 30 seconds to get everyone logged in here. Chandran, how are you doing today?
I'm doing well, thanks, Julia. Looking forward to this seminar. It's looks like it's going to save some money.
Save some money and what things we need to think about between now and year end, which is only what, 3 weeks away?
I know this year sure has gone fast.
That is for sure.
But compared to 2020, I'll take it. It's a great year.
Yes, yes. All right, I just want to remind everyone that feel free to use the chat function, the Q&A function. If we don't get to your questions right then we will make sure to leave time at the end where we can do some question and answers. I will go ahead and start our screen share here. We're good to go. Chandran, are you ready to start?
I am.
Okay.
All right. Well, welcome everybody. Welcome to our year-end tax and charitable giving strategies webinar. Now, our goal is to provide education, present ideas, and cover some strategies in your financial plan. We think in financial freedom, we think a better education leads people to making their own informed decisions about their finances. That's what's very important. As we go through this webinar today, we encourage participation, and there are no wrong questions, right? If you have a question, chances are somebody else had the same question. So please note those, and we will answer them sometimes during the presentation and definitely at the end. But as we go through this webinar, ask yourself the following. How does this webinar and the legislation that we're going to talk about affect me or affect a loved one, like think your parents? Will it cost me money or will I benefit? How can I position myself to benefit even more? And what do I need to change now and in the future? And what do I need to worry about? Now, a little bit about us. We're Financial Freedom WMG, and we founded in 2000. Sometimes I say in front of the turn of the century. You know, somebody as old as me, turn of the century usually meant a long time ago. Well, in this case, it's 21 years ago. And as you can see here, we're a comprehensive wealth management and planning firm, and our commitment is to help our clients achieve financial freedom. We serve a whole gamut of people, retirees, business owners, people going through transitions. Transitions not just in if somebody passes and you're taking over parents' 401k, that kind of transition, but also retiring or changing jobs or changing careers, those types of transitions as well. We have a huge team, well, huge, but it fits on one slide. Actually, there's 15 of us as of today. Here's a picture of some of the team members that we have to serve you. And a couple of key things. Looks like we mostly wear blue, sometimes red. Oh, I've got the red tie on. More importantly, though, we're here to help you. We're committed to helping you in your financial life. So that's our team that's out there. Oh, wait. And today, Julia is going to be the main presenter. She's our expert when it comes to tax laws and tax and charitable giving strategies. She founded this company 20 years ago. I kept saying, you know, from your kitchen table, but apparently it was from an office in a part of a room upstairs in the house. You know, always interested in money and helping people do better with their money, starting as a teller in a branch and then moving on to now one of the top firms in the broker-dealer LPL Financials, 20,000 advisors, and build a great business of satisfied clients. Julia, congratulations.
Well, thank you, Chandran. And, Chandran, a lot of this is thanks to you for joining me about 10 years ago and really coming beside me and helping, cast this vision of, building a wealth management firm that focuses on helping our clients pursue financial freedom. And those principles and the management and the expertise and the life expertise that you've brought to us has been awesome. Chandran actually wrote a book called Catch the Arrows, and it's for sale on Amazon. I would encourage everyone to check it out. But those principles and those leadership principles are a guiding light for our staff, our firm, and I think it trickles out to our clients as well. And so, all right, so we have a lot to talk about today. We are going to get into, I'm going to just prepare everyone. We're going to talk about facts and figures. This may be a little nerdy, but I will try to kind of bottom line it and give you some nuggets of things to think about between now and year end. We believe in proactive education and taking proactive action in your finances. And a lot of that, needs to happen before tax time. When we think about tax time, it's the first quarter of next year, and it's hard to go back and do things for this year. And so let's first start with an overview of our tax system. In the United States, we have a progressive tax system, which basically means that the higher income an individual or a married filing jointly couple have, the more taxes that they will pay. And so this is the current 2021 ordinary income tax rates. And if you look at the pyramid going up the middle, it starts at 10%. That is the bottom tax tier of the tax rate and goes all the way up to 37%. So if you're married filing jointly, you would, if you think about what your income is, so for example, if between you and your spouse, if you make $125,000, that means you're falling in the 22% tax bracket because the top of that is $172,750. And then on the left-hand side, as a single taxpayer, those are the income levels as well. So what I would encourage you to do is take a mental note about, estimate what your income is, and then kind of take note of what your tax bracket is, just rough sketch. So as we go through this, you can start thinking about some strategies that I'm going to put out there. Okay, so it's important to note that if nothing changes with our tax code, in 2025, the tax cuts that was put into place in 2018, those will go away and they will roll back to where we were at in 2017. So in 2025, they'll revert back to 17 levels. And you can see here the difference. So it's basically about a 3% tax cut that everyone got back in 2018 as the year it went into effect. So again, just something to think about, but that's on the horizon. Capital gains. So capital gains is a different tax rate than ordinary income tax. And so on the left-hand side, now this is based on long-term capital gains. So to qualify as a long-term capital gain, you would need to hold an asset for more than 12 months. So for example, if you bought a stock last December and you're selling it this December, you need to make sure that you've held it for over 1 year for that to be considered a long-term capital gain, which makes a big difference in what kind of taxes you pay. So in this example, if you are in the 12% tax bracket or below, based on the chart that I just showed, then your tax rate for capital gains is 0%, which is very generous. If you are above the 12% bracket, so if you're in the 22% bracket, all the way up to the second to the top, so not, then you fall in the 15% bracket for paying capital gains. And then above that, that only the top tax bracket is where you would pay 20% capital gains tax. So you can see the income levels there on the right, whether you're single or married filing jointly. So this is important, like if you were selling real estate, if you were selling a business, if you were selling a stock that has capital gains, you want to make sure you know and understand what you're paying on tax-wise. If you've held assets shorter than a year, then you would be paying ordinary income tax rate on that gain. Now, with the tax law changes in 2017 to 18, they increased the standard deduction, which most Americans take the standard deduction now instead of itemizing. So if you're a single taxpayer, your standard deduction for 2021 is $12,550. And if you're married filing jointly, it's $25,100. So again, a lot of us that do charitable giving, we're not actually able to deduct that on our taxes because the standard now is high. And so again, we're going to talk about towards the end of this, some strategies that we can use to maybe still get the tax deduction on those charitable giving. Now, I'm going to transition now to how estate taxes work. So estate, what we mean about that is at death, what happens? So at death, your assets are totaled for calculating your total estate worth. And anything over the exemption amount is taxed as estate tax rates. Now, I'm going to share what those are here in a second, but it's important to understand how estate taxes work. Now, I will make a side note here. If you are a married couple, so for example, me and my spouse, we both have to die for estate taxes to be triggered. But what will happen is if one of us dies first, which was most likely would be the case, all the assets move from one partner into the other. And so if no estate planning is done, at the second death is when these estate taxes would come into play. Another note that's important to understand is retirement accounts, unless it's Roth IRA, are always taxable at death to beneficiaries, unless it's a charitable institution. So that is a very common, a lot of times when we plan with clients, that's often forgotten that their beneficiaries will be paying taxes on the IRA money. So currently, the federal estate tax exemption is $11.7 million. So that's a lot of money. Most Americans don't have estates bigger than 11.7 million. And what that means is if you die, if you're single, or between you and a spouse, if you die, everyone gets an 11.7 million. So between spouses, it would be, over, what is that, 23 million and some change. So meaning there would be no federal estate taxes due unless your estate was over $11 million. So that is what's up for, let's say, negotiation, if you will, or part of this new Build Back America plan, is that they are considering reducing that federal estate exemption down to around 5 million, which means that more Americans at death, their estates would be paying taxes. Now, it's important to note, as most of us on this call are Oregonians, and the current estate tax exemption is $1 million. So a lot of clients that we help, as they retire and move into their retirement, their net worth is greater than $1 million. And so in Oregon, if you died in an estate with bigger than $1 million, that's where Oregon estate taxes would be owed. So there's a potential for in 2021 here to do some gifting if your estate is bigger than $5 million, because you could gift now using part of this exemption while you're living and reduce your sizable estate. And then if it's reduced to 5 million in the future, it's like you either use that gift allowance now, or once the new law goes into force, you would not be able to use that in the future. Kind of confusing, but again, if we need to clarify anything, we'll come back at the end and be happy to answer any questions. Okay, here's the thing about estate tax rates, estate and trust tax rates. The income, the taxable income, it doesn't take very much to be in a top tax bracket, paying taxes. So if you have an estate or a trust that is making over $13,050 each year in income, that is in the 37% tax bracket. So like I said, looking at this, if it's a trust entity that is paying its own taxes, it's pretty fast to get into those top rates. And these are just federal rates. We have to add on state as well. So Oregon, we'd be adding on another 9%. So we'd be getting close to over 46% taxes for estates and trusts. Okay, so here are some tips to think about. When you have charitable giving intentions and you want to leave part of your assets as a legacy to those nonprofits, consider naming those charitable institutions as beneficiaries on your retirement accounts. The only exception to that is Roth IRAs. And Roth IRAs should definitely be left to your kids, to families, to real people. The reason why is Roth IRAs by nature are tax-free. And so those you'd want to go to an actual person. The IRAs, the 401k rollovers, the qualified plans, that will always be taxable to a real person. Your friend, your kids, as long as it's a real person. If it goes to a charitable organization, no taxes are due. So we always encourage, do your charitable giving out of your traditional IRA accounts. And then name your family or other beneficiaries to your actual trust or non-retirement assets. So this could be your house, this could be stock that you've owned. What happens currently is when you pass away, when you die, those assets are valued and your beneficiaries get a step up in cost basis. So unless your estate is over $1 million in Oregon or currently 11 million in federally, your beneficiaries would not be paying taxes on those non-retirement accounts. Okay, so let's talk about charitable giving. I think in the year that we've had very good returns in the stock market, there's a lot of clients that have appreciation in whether it be real estate or in stocks. And when you think about giving to charitable organizations, a lot of times we think about just writing a check. It's very normal. It's what we're doing at the end of the year. But I want to encourage you to think about, you can also donate appreciated assets. So we manage money for nonprofits. And this time of year, we're helping facilitate gifts that are coming in to those nonprofits that are stocks. And so what that means is you don't actually have to sell and realize the gain in the stock. You could actually gift that stock to your favorite nonprofit, they can sell it without paying the capital gains. You do not have to pay the capital gains, and you get a deduction for the fair market value of that gift. So that's something to definitely consider during the giving season here. All of us have, there's an annual gift tax exclusion. Currently, it's $15,000. It's the same as last year. And what that means is all of us can gift $15,000, whether it's cash, a stock, an asset, anything worth $15,000 to another person. And we don't have to claim it on our taxes, and they don't have to claim it on their taxes. So it's a tax-free moving money around. If you are married, between you and your spouse, you could gift then $30,000 to another individual without that taxes. So a lot of times where we see this is grown children. We have clients that are, their estates are getting bigger. They want to consider a gifting strategy with their adult children or maybe grandchildren for paying for college. So they can, each spouse can gift to as many individuals as they want. So kids, grandkids, $15,000 each. So again, it's another way. If you're up over that $1 million, your life is secure financially, you could start thinking about a gifting strategy as part of your legacy. And again, it doesn't need to be cash. We can do this in stocks, investments, whatever assets you have. Okay, and for 2021 and 2020, which was the 2020, the CARES Act came out in response to the pandemic. And what the CARES Act states is that they will allow for a charitable contribution up to 100% of your adjusted gross income for 2020 and 2021. Now, this is up from 60%, which is the normal amount. So just for round numbers, if my husband and I make 100,000 and we want to give away 100,000, then essentially we can write all of that off in 1 year. Typically, we would be limited to only 60% of our AGI. And it's not that we've lost the additional deduction, it just is carried forward. So the next year we would get the additional 40,000. Another part of the CARES Act, which I would encourage all of us, most likely we could take advantage of this, is in 2020, there was a new line on the 1040. This is the first page of the 1040, where it said, if you gave $300 cash in charitable giving, you can just write that off on your taxes. So for 2021, please note that it is now $600 for a married filing jointly couple. So all of us get $300. We don't need receipts. We can give it to our favorite charitable organization and be able to deduct that whether we itemize taxes or not. Okay, I see some questions coming in, so I will come back to those because I know I'm going to address one coming up here. So what about, great questions, qualified charitable distributions? So these are available for an IRA owner after the age 70 and a half. So you have to be 70 and a half to take advantage of this. But it allows us to contribute up to $100,000 coming from your IRA and moving that directly to your favorite nonprofit. It just has to be a qualified charitable organization. So what this does is, oftentimes when we do our giving, we take money from our IRA, it comes into our account, and then we write a check to the nonprofit. because of the standard deduction now, we most times can't take that as a deduction. So what this does is it keeps it totally off your tax return. You're moving it from your IRA to your nonprofit. You don't touch the money personally. And so it does two things. It qualifies as your required minimum distribution, which now doesn't come into effect until you're 72. And it also helps you give money directly to the charity and not pay taxes on the money. So very good strategy. We have a lot of our clients that we actually get a checkbook for their IRA, and they can write a check themselves directly from their IRA to sending it to their nonprofit. So definitely a great strategy if you are 70 and a half and older. Okay, let me answer this question. If a gift to someone using money from traditional 401k and I am older than 59 and a half, is the distribution money withdrawn considered income like a normal distribution? Okay, if I get, yeah. So if you are gifting to an actual real person, not to a nonprofit, then you would still pay income on that distribution, and then you'd have to write them a check. So there's the only way to get money out of an IRA and not pay taxes on it is what we just shared, the qualified charitable distribution. Great question. Okay, another option. So we're leaving the retirement account world, and another strategy that we're seeing become more popular is what's called a donor advised fund. And what a donor advised fund is it maybe if you have a one-off event, a one-off taxable event in a year where you're paying more taxes than normal. So we see this for, let's say you sold a business, or you sold a piece of investment real estate, or you have a big capital gain in a stock position. So that is like a one-off year where more taxes are going to be owed. So what we do is we can set up what's called a donor advised fund, and we can fund that donor advised fund with cash, with stock, with assets. Once it's in that donor advised fund, you've essentially given that away. But you as the donor can maintain kind of like you're listed as the trustee, and you decide as trustee of the fund now who is going to benefit from this going forward. So it could be the local food pantry, it could be the local hospital, Red Cross. The money can be donated at any time in the future to any nonprofit. The nice thing about this is maybe you want to put $10,000 in there now and grow and build that fund for a couple years. You can get the deduction for putting the money in up front. It grows, and then when you start to do giving, you don't get a tax deduction then, but you can build that and grow those assets so you have more money to give down the road. But you're allowed to take that tax deduction, that bigger tax deduction up front. Okay, so let's talk about some of the proposed tax law changes that are in this Build Back America proposal. Now, what I'm going to talk about right now, it's not law. So this has not gone into effect. This is just kind of what's been in the proposal, what will be most likely enacted. I think the percentages are getting higher, but there's still work to be done on making this into law. So we will see. Maybe we should do a poll about what percentage of us think this will be enacted. Okay, so the first one is the SALT. So SALT stands for state and local tax. So if you remember back in 2018, some of us got capped at what we could actually deduct on our taxes. So this is for Oregonians. We have a lot of state income tax. We have higher property taxes. And so right now that's capped at $10,000. So the proposal is that they will increase that to about $80,000 $40,000 for individuals. So that could be a benefit to Oregonians. They're also talking about imposing a 15% minimum tax on profits of large, meaning over $1 billion in profits. So these are large publicly traded companies that would be impacted by this. Third is electric vehicle tax credits. So I think from the results of the infrastructure bill, I think where all of us are seeing this shift, whether we like it or not, to electric vehicles. Now, I know Chandran is going to have a problem with this because there's no more sound coming from the cars. But, you know, it is the way that the automotive industry is going. And so, they are talking about a tax credit of up to $8,500 if you invest in electronic vehicles in the future.
Yeah, I'm stuck in the 60s. I need those muscle cars and that roaring sound that they make. Sorry.
And I also want to say a side note of that, what's also happening with that infrastructure bill is America is investing in electronic charging stations across the nation over the next 5 to 10 years. And if we are managing money for you, you will most likely have portions of your portfolio that are invested in this electronic charging, what would be industry, or so you're getting exposure, I think, to the benefits of what that sector will bring over the next 5 to 10 years. Which we're excited about that. And then lastly, the retirement plans. Now, if you're a lot of the rules around retirement plans that are proposed are very high net worth, meaning if you have over $10 million in an IRA, which for most of us, it's not going to apply to us. But I think what will be more applicable is you could do something called a backdoor Roth IRA, which is essentially if you make over the limit to contribute directly into a Roth IRA. We used to be able to do a non-deductible IRA contribution and then immediately convert it over. So the ability to convert IRAs to Roth IRAs are going to be limited by income. And that strategy may not be available anymore. So I think another thing to consider is if you think a Roth conversion would be appropriate for you, reach out to your advisor, to us, and we will help you figure out if it makes sense for you. And I would definitely consider doing that before the end of the year. That is a 12/31 deadline. And so if we can convert and that makes sense for you, that's definitely something to think about. Okay, so I've gone through a ton of information here. It's kind of like a fire hose, but I hope it's been helpful. We are going to spend some time here on Q&A, but before we do that, we will offer, so if we've talked about anything that is, you just want a consultation about how this is going to impact you individually, go ahead and text the word "give" to this number, and we will schedule that review with you. If whether you're a client or a friend visiting us today, go through this process because that will give you a schedule link to get on our calendars. And a lot of this stuff, like we've discussed, has to be done prior to year end. And we've also just released our 2021 tax guide. And if you text "give" to that number, we will actually get this tax guide to you as well. So it's got a lot of great information in it, and it's just really helpful to look at for your planning.
Good, Julia, that's great. Just one thing that everybody should know is that if you become a client of ours, your funds, we do not take custody of your funds. It's held by our broker dealer, LPL Financial. LPL Financial has been around since about 1968. It was formed by a merger of Linsco and Private Ledger, thus the LPL. They are the largest independent broker dealer in the country. And one of the reasons we like them, the many reasons, but the one key one is they have no proprietary products. So there is no LPL fund that they want us to put some of your money into. We are totally independent and can choose whatever is best for our customers. And LPL does all the support in the background that helps us execute that. There's every client, every account is part of the SIPC, which is a membership for $500,000 account protection for each customer. Now, that's if LPL goes bankrupt or something, it's covered by $500,000. But in addition to that, there's $575 million of private insurance LPL has. So it's good to know. We've been with them for many years and they provide great support. For the next 25 minutes, we'll read this important disclosure. There will be a test on it a little later. So if you want to get a reprint of this webinar, seriously, these are the fine print that you have to look at for 5 seconds. But we're happy to talk with you. If you have any questions, if you'd like for us to sit down, any one of our 6 advisors to sit down and go over your plan, give you some advice. It's a complimentary consultation. If nothing else, we can give you a second opinion on whatever you're doing. We'd love to talk to you.
Great. Okay, so let's answer some questions here. We got some good questions coming in. How does giving a charitable contribution for my 2021 RMD affect my taxes? So, so there's 2 different ways that can happen. So if you do what we referred to in the presentation of what's called a qualified charitable distribution. So if it goes directly from your IRA to the nonprofit, it's going to completely stay off your tax return. So if you're over 70.5, we encourage our clients to do their charitable giving directly from their IRA. So if you've already taken your required minimum distribution, then you would be able to, and then you do charitable giving, then you're going to be limited to if you itemize taxes or you take the standard deduction. Although all of us will get that 300 or 600 married filing jointly little bonus for 2021. So hopefully that answers that question. If I gift my child some stocks that have appreciated in value, are they taxed on the increase in value, stepped up basis, or something else? Very good question. So when you gift stock to a child or anyone, and you are still alive, they take on your cost basis. So if I bought a stock for $50, it's now $100. I gift it to my son to pay for college. If he sells that stock, his cost basis is $50, not $100. The opposite is true is if you die and he inherits it, he's going to get that step up basis only at death for the $100.
Julia, just a clarification that I just have on that first question. Is the gift then $50 gift or is it $100 gift?
The gift is the current market value.
Right, $50 gift. Even though the cost basis, no, the $100, even though the cost basis was 50.
Correct.
Okay.
Yeah. Yep, good questions. Okay, I was once cautioned by my CPA that when I gift money to my children, the feds may ask for it back from my children later if I run out of money and go on welfare or Medicaid. Is that still true? I'm not sure if there's a statute of limitations. So the way, I'm not an expert in this, but the way that I understand this is, let's say you gifted $200,000 to qualify for Medicaid. So Medicaid is the government's program that will pay for long-term care, pay for programs, but you have to spend your assets to nearly zero to qualify. What they do, there's a 3-year look back where the Fed would come, if you went on Medicaid, the Fed would look back 3 years and said, okay, what gifts have happened in the 3 years? Because what they're preventing is they don't want you to give everything away and that just to go on Medicaid. So, but that usually happens in bigger gifts where someone is trying to go around the system. So in a ordinary gifting where you're gifting 10,000, 15,000 a year to kids, you know, most likely that's not going to come back and, you know, in that look back, but the look back's 3 years. Do you have anything to add there, Chandran?
Just, I believe Oregon might be 5 years, so we should research that a little bit more as to what that difference is.
Okay. Another question, can one do a Roth conversion in the same year as taking a required minimum distribution? So yes, you can. And what that means, here's the information, like on Roth conversions, any money that moves out of your IRA into your Roth is taxable. Any money coming out for an RMD is taxable. So you can do both, but if you do a 10,000 required minimum distribution and a 20,000 conversion, you will pay taxes on 30,000 total. So it's just important to understand where you fall in the tax brackets. Our common recommendation is if you are falling in that 12% tax bracket or below, so a married filing jointly with adjusted gross income of about 80,000, 40,000 for single. If you're below that, then it is wise to consider a Roth conversion because you're paying taxes at 12%, where we know in 2025, that tax rate will most likely be 15%. So it's kind of just some general overarching strategies. But again, you know, really reach out to us and consider working with us to get the right tailored solution for your situation. Okay. Another question we got was, how does cryptocurrency get taxed? Ooh, that's a good question. So cryptocurrency is considered an asset or an asset currently. So if you bought cryptocurrency 2 years ago and you bought it for $1,000 and now you're selling it at $10,000, you would pay long-term capital gains on $9,000. And so there will be more crackdown on this and reporting and official rules. I was actually listening to hearings that was happening this morning about you know, the laws that are going to be put on you know, governing cryptocurrency. And so, but currently it is considered an asset. How do I make an appointment with Julia? Chandran, how do they do that?
Just, you know, what you do is a text. You can call us at our numbers 458-777-4458. And we can set up an appointment with not just Julia, but her 6, what would you call it? It's like the disciples, I guess you call it. We've been tutelaged by Julia. There's 6 of us wealth advisors. I'm happy to talk to you.
Yeah,
depending where you are, we're all over the state. You know, we're in Oregon, and then of course by Zoom in 37 states in the country we have clients. So wherever you are, either by in person or by Zoom, we'll be happy to talk to you.
Yeah, and we work as a true team. I think that's one thing that differentiates us here at Financial Freedom Wealth Management Group is you get all of us. So, you know, if you may not see me in the lineup, but you're definitely, you know, getting the team, and I am right there for any strategy or advice or, you know, just assisting in that work with our advisors.
And I think that one of the key things about the team is that we use Julia as our tax expert and our charitable giving expert. So anytime any of us have clients that have more detailed questions, we would confer with Julia. Similarly, I do the Medicare and Social Security, Medicaid issues because I started my career in this business as a Medicare specialist. So I'm happy to talk to people about that. So as a team, we get the benefit of the best from different people. DJ is our portfolio manager, the one who does the research and all those sustainable investments. So no matter who you talk to, you get the full power of the team and the different passions and expertise we have.
Very good. All right, everyone. Well, I think that is all the questions. We hope that everyone has a good year ending here and a happy holiday season. And we thank you for tuning in and attending and sharing this with your loved ones, with your friends. You know, a lot of our clients come through referrals, and we just really appreciate that and are grateful. Any parting words, Chandran?
No, again, hope you have a great rest of the year. 21 is just about over, and have a wonderful 2022 if we don't hear from you before.
Bye, everyone.
Bye.